Hi everyone, this is Michael Ben-Ghiat. This is the Market Trend Advisory Weekend video for July 9th, 2022. Before we start, here's our disclaimer. You can pause the video and read this. I'm going to keep this pretty short. I'm a little under the weather this weekend. But right now, the market is kind of in a holding pattern. The overall trend for both indexes is uptrend uncertain or uptrend under pressure. We do have some divergence between the two indexes. The Nasdaq is outperforming, acting quite a bit better. And so we do have a market count of 2 with 55% exposure for index investors for the index. And we have 0 for the S&P. Hasn't quite hit any of the criteria to produce any market count buy signals. In terms of individual stocks, we're up to about 15% exposure. They've been starting to act better than they have for a long time, but still, it's we're in a bear market, so it's not the time to be piling in with tons of stocks. And a lot of the leading stocks that are working and breaking out, been a lot of volatility, a lot of false breakouts. They fall back into their bases. Sometimes they just plunge out of the blue. And what is that really telling us is that there's not a lot of institutional support. In a strong bull market, when a stock breaks out, you'll usually see it on nice, very strong volume, and you want to see it at least 40% higher than normal. And then in the days following, you'll usually get some other institutional support, and you'll see other days that are showing lots of volume too. In other words, institutions are buying the breakouts, and they're behind the moves. When you see breakouts that come in one day and then fail, it means either the institutions are selling into that because they're just decided taking their profits out of that, or it's just all retail buying and selling, which for the most part doesn't push the market up and down to the big moves that create these bull markets and bear markets. So we're still light on that, and that's fine. It's that's just been the way it is for quite some time in the market. So we just keep our exposure light until the market tells us that we should have more exposure in individual stocks. So here's our investing strategy for the QQQ and SPY. You can see we're at 55% exposure for the QQQ and 0 for the SPY. One thing we just added is we have the current strategy is the market count 1x, just to be clear which one we're following. So that's why you're seeing the composite strategy is matching the 1x. And then again, if during the year we were to switch over to the 2x or the 3x, this would actually trigger in if the market is positive, and then we end up starting a new cycle with the market in positive territory, we would switch to the 2. But for right now, we're still firmly entrenched in a bear market, and we're just using the market count 1x, no leverage, just using the SPY and just using the QQQ. But we're still, vastly outperforming the buy and hold of just the QQQ and buy and hold of the SPY. So that's all looking pretty good. So here's just the chart of the Nasdaq. You can see that we've had 4 days up in a row. We had a little bit of resistance at the 21-day, which is this green line. It's starting to curl over again, which is a good sign. We still have a downtrending 50-day, which is the red line, and we're getting resistance right there. It looks like 2 days in a row. Haven't quite been able to get it. A little bit of concern for this market is you can see the volume is just declining each day. So there's really not any institutional support for this rally. But one thing I'll kind of just skip ahead here is that we are, in terms of sentiment, we got pretty bearish. It's starting to recede back to just bearish instead of very bearish. That's kind of giving us in a contrarian view. That's kind of telling us that a lot of people have sold. Maybe it's a little bit sold out. We are oversold. That's kind of the typical term that people use. It's an oversold market. So we're starting to work off some of that oversold. In fact, let's just go over here. Yeah, here's the sentiment. And you can see that we've come off very bearish. We had some, pretty heavy put call days. Anything over 1.1 is kind of points to some kind of a low. We're starting to, we're back at 0.75. So we're really just kind of cruising back up. And less fear. The CNN fear and greed is at 30, it's the highest it's been for a while. The VIX is also increasing, or going more towards 0. So all in all, in terms of sentiment, yes, we have sort of put in a bottom of sorts. Who knows if it's the bottom? Probably not. And then in terms of technicals, you can see that, the Nasdaq percent above its 50-day, we were down, 13% below, and we've crept our way back up to almost basically even. And same with but we're still far in the 200-day, the Nasdaq percent above the 200. We were down at almost 25%, and now we're down at 16. So that's good. So we're kind of working it off. But you have to remember, under the surface, it's very, very weak. I mean, 52-week lows versus 50-week highs. Let's see, are there even any? I don't even think there's any in this chart, which is going back a month. 52-week lows have every single day. Sometimes, you can see with a ratio of 0.01, that's just like 11 highs and 1,381 lows. It's decreasing. We're getting a little bit better. You can just see from the ratios. But, maybe this is pointing to a bottom. It just got washed out. But we're still, we're not even 20% of stocks above their 200-day moving average. So that's a little bit of concern. So there's not a lot of juice behind this move. Could this rally? Sure. Could it even get up to the 200-day, this black line? It could. The market's looking for any reason to rally, and every single note, every single report is being scrutinized. And I say probably this week things have changed, and even if something came in stronger than expected, it's being interpreted as bullish. If something comes in weaker, it's being interpreted as bullish. So basically, everything is starting to be like, no, it's all bullish, because it's going to either mean inflation's peaked, or we're not going to have a recession, or a recession is going to be really mild. So that's how the market's kind of interpreting things right now. So let's go back to the S&P. You can see it's a little bit weaker here. Haven't quite even closed completely above the 21-day. That's one of the buy signals. The low has to be above the 21-day, so we don't have that yet. And we even had a little bit of a down day on Friday. So that's it. We're just still kind of a holding pattern, but the market looks like it's trying to just put in a bottom of sorts. But remember, coming off of the massive bubble that we had, it's probably highly unlikely that this whole thing is over in 6 months, since January when this started. So just a few final things to wrap up here. So this week we have consumer inflation data and the start of the second quarter earnings season. And so that could set the course for markets and result in pretty volatile trading in the week and the following weeks ahead. So the key question right now is when is inflation going to peak? And as it's as it's already continued to remain elevated much longer than the Fed had initially anticipated. And the markets are at least hopeful, if not expecting, that inflation is already starting to decelerate, although there isn't much data to support this yet. Again, as we mentioned, the second quarter earnings season starts this week, and second quarter earnings for the S&P are expected to grow 5.7%. And it seems highly unlikely, with already a lot of companies pre-announcing decreasing revenues and compressed margins. So analysts have so far left their estimates unchanged, but may be forced to lower estimates and guidance for the rest of the year. That will be a pretty big headwind for the market. And companies may continue to beat, but maybe it's not as much as hoped for, and that's be another headwind. So we'll see how that plays out, and we'll be getting probably by Friday we should have a pretty good idea what's happening, because by Friday there's a lot of big companies that are going to be reporting. And then finally, just some key reports. Wednesday we got the June CPI, that's Consumer Price Index, expected to show continued inflation. And this is one that can move the market a lot. So that's going to be another possible fireworks 4th of July day. On Thursday, we have the June PPI, that's Producer Price Index. And then Friday, we have the University of Michigan Consumer Sentiment Report. And this is something that the Fed looks at a lot because it contains consumer expectations about inflation. And then also on Friday, we have the June retail sales. So a lot of reports coming out. I expect overall we'll see some big moves in the market. I guess that's about it for this week. So I couldn't tell you what's going to happen. If we'll be up or down, you never know. The market's trying to just interpret everything as optimistic. But if these come in really just more than the market was expecting, or even can kind of justify, we'll see a continued sell-off. But anything can happen, and we'll see. So at this point, keep your exposure to the market at a minimum. At least in the indexes, you're at 55%, only for the QQQ. Nothing for the SPY, and minimal exposure for individual stocks. All right, we'll be back next week. Okay, thanks.